Gosh, I always say your cash is sitting on the shelf. So if you can't move your product fast enough, you just locked in all your money into that shelf over there where your product is sitting. So you need to know your sales cycle, and you need to know how quickly can you move inventory off the shelf, and you need to work with a marketing agency or someone like Pat to help you create a strategy on how you're going to get more customers to buy your product and make sure that that's working and working well, because otherwise you're just sitting on inventory, your money's tied up, your cost of goods margin is probably not as good because you're just spending more money on things that you're not selling.
You're listening to Customer Growth Sessions, presented by Intergrowth, where we talk through strategies to help up-and-coming e-commerce businesses bring in more customers. I'm your host, Pat Ahern. Let's jump in.
All right, listeners, welcome back to the latest episode of Customer Growth Sessions. Today, I'm thrilled to have on Carla Titus, the fractional CFO and founder over at Wealth and Worth Within. Carla, welcome to the podcast.
Thanks for having me. I'm excited for our conversation today. I'm going to break down some details on finances for everyone.
I love it. I was going to say, this is about as in the weeds as it gets with a podcast episode. This is going to be a fun one.
Yeah, can't wait.
Before we jump into the numbers and maybe provide a little bit of sleeping assistance to the people who are listening to this right before bedtime. No, Carla, tell us a little about the business. What do you do over there?
Yeah, so we're a fractional CFO firm. So we're essentially helping you navigate your money decision making in the business, helping you improve the financials by, running financial analysis, modeling out scenarios, helping you figure out how to reduce your cost and increase your profit. And, helping the founder be very confident and get clarity around the financials of the company so they can make better decisions going forward.
I love it. And financial clarity is exactly what we're diving into today. So, listeners, real quick, little bit of context. We're going to do a very unique type of episode today. I'm actually going to share my screen. Carla and I spent a few minutes before this putting together what I'd call is it fair to say like a simplified model of what financials might look like for an e-com brand at two different stages of the business, let's say.
For sure. Mm-hmm.
If you are listening right now, via audio only, I would highly encourage you, check this out on YouTube instead so you can see the visuals of what we're looking at. We're going to walk through all these numbers. We're going to walk through all these terms. You'll still get a lot out of the audio side, but I would really encourage you check out the video version on YouTube. With that, I'm going to share my screen. We're going to take a look at this financial statement for this jeans brand and walk through what we're looking at here. All right, listeners. So, little bit of context. We are looking at a hypothetical jean brand operating at two different stages of its life. First stage, as we can see right here in column B, is going to be when it's doing $100,000 in annual revenue. Second stage here is going to be when it's doing $750,000 in annual revenue. Now, finance has a lot of nuance to it. So we're going to eliminate a few of the more complex items that can add just additional variability into the mix. So we're going to strip away things like seasonality. We're not going to specifically talk about tariffs today. We're going to operate with a few simplified financial assumptions in the mix to really get to the meat of some of the other items that'll come into the mix as this brand is growing in trying to figure out where to invest their spare dollars. So with that, Carla, where do we want to jump in with this document? Should we start out by taking a look at what are these high-level revenue metrics and cost metrics in the mix, diving into what each of those mean, take it from there?
Yeah, let's start by reviewing that because I think it'll be a good way to help our listeners baseline what we're talking about. And so let me just kind of walk through both of the inputs on each of the phases. So we start by looking at top line revenue. Pat already said 100,000 versus $750,000 company. Then we're going to look at the units sold for each of those. Phase one, $100,000 company is doing about 2,000 units per year versus a $750,000 company is doing about 15,000 units per year. Now, we do have a similar price point, but different cost of goods for this model. And that's to indicate that as you scale and are having more buying power and can negotiate better terms with either your manufacturing, cost of materials and your direct labor and efficiencies and yields, that you're getting a better outcome from that efficiency and gaining a few points in cost of goods margin for your company.
Just for clarification, so Is that something I should expect for my business that, once I reach a certain level of scale, I have a little bit more negotiation power to be pushing back towards the manufacturers and whether it's 5%, 10%, but pushing to get a little bit more profits, pushing to slightly lower costs, or is this more so an outlier scenario?
I think you should be requesting a conversation and everything is negotiable. Okay. So if you haven't learned that yet, like you should be asking no matter what. Now, there might be where this, manufacturing facilities, like we have a certain level of units you need to order in order to give you a price break. So now you know what that is and are you hitting it or not. So there might be a little bit of that and you might not be close to it. So it just depends, right, on who you're working with. You could also map out and say, hey, I'm going to be growing this again and I will like a preferred price now and then we'll continue to do business with you. So there's a lot of levers you can try to pull, but at the end of the day, if they're like, no, the price is what it is, then you have options, right? You can shop for a different vendor that you do business with. You can do in-house operations. Like you have to decide what is your lever to pull if there is not something you can gain from a margin perspective, because that's what's going to allow you to have more profit to pay for all the other costs that you have in the business. And I'll just add, it's not an expectation. You have to actively manage it. It's not just going to magically happen because you went from $100,000 to $750,000, which I think is what people think, right? They're like, oh, I'm doing more units, therefore it should be cheaper, it should be easier, it should be better. And that is not the reality. Sometimes costs go up. And so you have to actively be managing that in order for that to be a reality. And then we obviously have economic realities. We're not gonna get into that today for like seasonality and factors outside of our control that drive up costs. But what you do have in your control is how you respond to that.
So you're telling me the manufacturer is not going to reach out and say, "Hey, Pat, good news, you sold a lot of units. Here's $100,000 for you."
Most likely not, because they want to keep as much as they can, right? They're also a business. So like, you have to be asking and proactively working through what are the things we could do to make a difference and gain that margin back to us. Okay, so then we are still keeping the same average price point for this product. So we're not using that as a variable, but just know that could be a variable. You probably have many SKUs and different price points. And so we're just keeping it simple here to make, to be able to show you a contrast scenario. But just know that we know that at scale, maybe you're charging a little bit less for the jeans and that you can, use that to your advantage to push more units out and then brings more revenue. And so like there's obviously strategies around price points as well that you can be using. We're just not going to insert that kind of variable into this conversation today. We will assume though that you have gained about 5% of improvement on your cost of goods on how either you're manufacturing or you're managing that production process to create the jeans and that you are bringing the savings into the company. And so that gives you a 40% cost of goods percent of revenue in phase one, $100,000 company versus 35% cost of goods in phase two, $750,000 revenue company. So again, that 5% improvement doesn't just happen magically. You got to work for it, like we were just talking about.
One follow-up question within that. So looking at, COGS of 40% of revenue or 35% of revenue, in your eyes, what would you see as an alarmingly high percentage for COGS?
Oh,
Or
great
similarly,
question.
what would you see as a level of COGS where maybe the profit margin that you see, the net profit, gross profit, I guess it would be, is so high that maybe you want to actually lower prices because maybe you're charging a little too much for the item.
Yeah, so we don't want that percentage to be. I mean, I've seen it, as high as 80%, to be honest. And I'm like, I don't know how you're operating this business because there is no any room left to pay anything else. Like essentially you're making $1.80 is going to produce your good. Like you have 20 cents to play with for the rest of the stuff. You have to include paying yourself, which is just not enough, right? So when that is the situation, you have to be working towards hitting this like 30-40% cost of goods. Now, depending on the industry and the material quality, and like I said, a luxury, and you still want to manage to this like 30-40%. It might be harder. And also, if you have too much labor costs, like there's other factors that, add to that you might or might not have control over. So making sure you look at this percentage as a way to kind of maintain a healthy cost of goods. Anything between 50 and 60% is going to be tough to still cover your overhead unless you have really lean operations that are administrative and you're maybe not even investing in any marketing, like which then you're not going to grow. So there's just a lot of other variables you can play with. You could still operate it that way, but I think your goal should be to get it closer to like that 30-40% cost of goods. And that's where we see we just have enough room to pay for everything else and still have room for profit, which is what we're aiming for.
Hey, listeners, reaching out with a big favor request. If you have taken anything of value away from the podcast, could you take a minute and leave us a review on whatever podcasting platform you're tuning in on? Whether that be Apple, Spotify, you name it, it would mean the world to us. Helps other listeners just like you to find the podcast and helps us to grow our following. Similarly, if you're on YouTube, give our page a follow, give this video a thumbs up. It all, again, helps us to grow the podcast. With that, back to the show.
Okay, so we covered, cost of goods. There's a few other variables I listed that we're not going to introduce, but it's definitely something I want you to be keeping an eye on, and that is average order size. So what is that on a recurring basis? Is it going up? Is it going down? What is your rate of returns? Like people sometimes return things. So you need to know what that is because that costs you money. And repeat customers, like how many people are buying again and again. This is important. And then careful with discounts and promos. I see this often not done really well. It's supposed to be a tactical short term to help drive. If you do it all the time, then now you're just educating your customers to expect a discount and wait for it to shop. So you don't want to be, making them build those bad habits because they're not, a sale's coming every month. So we're just going to wait for the sale and then buy. Because now you're impacting your average order size and your average sales price, which then means less revenue, but same cost of goods. So now there's not a ton of room for profit, right, per unit. So unit economics is just critical to manage. And I think depending on which products you're selling, and we're sticking to just one here today, understanding which products are your highest performing margin products is going to be important because, it doesn't all fit nicely in the 30-40% cost of goods. Some products might fluctuate depending on price. It might actually be better. It might be a 20% cost of goods percentage because you have a higher price point and better margins on that. So, it's all a mix. But here we're looking at the high level picture.
Absolutely. Real quick, the great opportunity I'm seeing to talk about loss leaders. So let's say we have a case where, there is one particular product where the cost to manufacture it is 80% of the price that we sell it for. First of all, what is a loss leader? How could that actually be beneficial to my business if I have that?
Yeah, so a loss leader, and this is where like Costco is such a great example of a loss leader. You're all familiar with like the hot dog and the rotisserie chicken, right? The price hasn't changed in like years, and people go there for that, but they're not just buying that. They're buying $300 or $400 more of other stuff just because that brought them in. And so it's essentially that you have a item or something that you price point is like super good and like people know it and they're like, wow, it's such a great deal. And they come into your store because of it, right? Online or in person. And that's what's bringing them in. You're not making money on that. Like, let's be clear. Like, you're probably either breaking even or losing money on that item, but that's on purpose. You're doing that on purpose. The question is, what did they buy alongside that made me the margin and the sale I needed to make a good profit? And is that working? Because if they're just coming in and buying that one thing, like they come in and buy the Costco hot dog and walk away, you did not make money. So let's be clear. If that's what's happening, and that will be some of that, right? If they're not buying that $300 shopping cart with all the stuff on top of the hot dog, then your loss leading strategy is not really working. So you need to know, what are they pairing it with? Are they buying 5 pairs of jeans alongside this one item that I have as the loss leader? Like maybe it's a belt or, some accessory that you sell that enhances the jeans. And you're like, yeah, I'm going to not make money on that, but it's definitely going to sell 5 more pairs of jeans because I have that item listed on my website that pulled the attention in from the customer to shop for that one thing and ended up shopping for a lot more.
Brilliant. Brilliant. I love it. Should we get into operating expenses next?
Yeah, let's do it. Okay, so then following we have operating expenses, and this is essentially everything else you need to run and operate your business. So you're going to have some kind of rent or storage unit, maybe when you're just getting started, you're operating out of your own garage. So you're not paying anything to anyone because you just don't have the money to afford a storage unit. And then you'll eventually grow out of it, right? As you scale your business. So we have zero allocated for that in the first scenario. In the second phase, where you're scaling at 750, you have about $24,000 of rent and storage costs. And, depending on the area you're located at, this might be realistic or completely unrealistic. So it just depends on your location too, on how much, rent storage units are going for. For marketing, such an important aspect of scaling, right? So I often see a lot of companies are not investing enough in marketing and the right kind of marketing, the marketing that actually moves the needle and shows results and helps reach the customers necessary to purchase your items for sale. And in the first phase, we just don't have it, right? We just don't have enough money to go around. So we're only spending $10,000 a year on marketing, which is just a good starting point, but definitely not where we want to see marketing be at. So as we scale, what got us to scale, by the way, along the way is upping the investment in marketing. So we have in the second scenario at $750,000, $75,000 is going towards marketing. And that will also set us up for, getting to that seven-figure mark ideally. And I think, Pat, you had some thoughts on like what level companies should be investing on marketing to really be able to see their growth materialize as well.
Absolutely. Yeah. So my take on marketing is, call it when you're at that $100,000 a year stage, a lot of marketing activity, call it a lot of marketing, let's broadly use the word investments, whether it be time or money, should be founder led and very much the do it yourself type approach. So most brands at that stage, I would definitely not recommend working with an agency if you're spending $10,000 a year on marketing. Agency management fees will take that up very quickly. What I would really advocate for probably 90% of businesses that I talk to that are at that stage is a lot of founder led marketing activity, whether that be, community engagement, community building, and whatever like one or two social channels are most relevant and most of your customers are on. Content creation, so let's say like blog writing, we could put like TikTok videos, YouTube shorts, almost as like a tangential category on the social side of things that has a lot of revenue potential as well. And then maybe take that $10,000, put the majority of that into some sort of pay per click channel. Google ads, meta ads are really the big two. They have a huge, huge market space and you can definitively reach your customer there. I would say variance is going to come into play depending on the specific product you're offering. Without getting too deep into the weeds on it, my baseline recommendation is if you have a product that people are actively going online to educate themselves about, if they're aware of the pain points that your specific product solves, Google Ads is oftentimes going to be the better investment of the two. Similarly, if you have a product that is maybe a little bit more of an emotional drive behind it, or if it's associated with a problem that customers maybe don't necessarily know that they have yet, they're not looking for that solution specifically online. They're not trying to alleviate that problem from a search engine like Google. That's where meta ads is going to be your best bet. So I would say do it yourself, learn how to set up straightforward and basic like meta ads, Google ads campaigns, use that as your initial scale. What I'll typically tell brands is when you reach like close to 1 million annual revenue, that's where it can be a really good time to work with a Google ads, meta ads partner that's going to help you reach the next level of growth. So when you're at that 750 mark, I would say you're like right on the cusp of being at a good point to bring on that agency partner. If you're spending 75K a year in marketing, what that probably translates to is like 5K a month in Google ads or meta ad spend, and then 15K a month in like miscellaneous creative email marketing, you name it. Once you're spending that 5K per month on meta ads and you're profitable there, good benchmark to go with, and I have this number highlighted right in here, is once you're getting a ROAS, return on ad spend, probably somewhere around 3. So in other words, every dollar that you put, let's say, into Google ads or meta ads generates about $3 in revenue for the business. That's going to be a really good point for you to start scaling up that investment, driving way more profitable revenue in the door, and then taking your business to the next tier from there.
Yeah. great insights. And I think at this first stage, like you were saying, do a lot of it yourself organically as a founder. Like you're just out there talking about your business, selling to everyone who's willing to buy your product, right? And maybe some of this marketing budget is actually compensation to you for managing the marketing in your business. Because as you can see, the next line we have is your wages. And this is, founder wages and maybe it's distributions or whatever way that you pay yourself. But as a founder, like taking compensation. And we only have it at $20,000 for the first stage. And then in phase two, where you're scaling to that 750 revenue level, you actually are at 150,000. This could mean two roles at 75 or one role getting paid 150. But just keep in mind, if it's just you, you're still doing a lot of work, working day and night on the weekends. And that's okay. If that's your, way to go about it because you want to get paid more, fantastic. If not, maybe you're hiring a second staff member to help you support the operations and help run things. But you can see that sharp distinct between, what you're making at 100,000. There's just not enough, right, to go around with all the costs you have to cover versus what you're actually taking home on the second phase or even hiring help to support you in the second phase. And it could be like a different split. It could be $100,000 and $50,000 for that position that, is coming to help you maybe part-time. But this is where, when you're scaling your marketing investment, you're also looking at your compensation, and like the bigger company you are, the more you can afford to pay yourself. So it's important that you're thinking about investing in marketing so you can get to that next level. Next, we have, software. This is just going to scale by number of users. So you probably have more users, same software. Now you upgraded the software. So it's just going to go up from $4,000 to $8,000 a year. And then business licenses, insurance, those type of things fit in the next category, 1,000 to start and maybe 2,000 on the back end. And, there's taxes. We got to pay taxes in business. If you're making a profit, you're paying taxes. This is a good thing. I know a lot of people hate tax. My philosophy is like, you're keeping the difference, which is much higher. So yes, there's tactics and strategies and things you can do to preserve more of your money and not pay so much in tax legally. Feel free to do that on the personal side. Like on the business side, if you're making profit, that's a good thing. You can qualify for loans if you want to buy manufacturing equipment, if you want to hire more people, if you want to expand, if you want to take a loan to invest in marketing, like whatever you're doing to help accelerate the growth of the business only happens if you're able to borrow capital or you have capital that you've preserved during the years that you build this to invest back, or you're using the profit to invest back. So paying taxes, again, not a bad thing. We just have to plan for it. So it's not a surprise. So we have a line here for that because tax should never be a surprise, at least in business, right? And then ultimately we have our profit line. And taxes are about 15,000 in the first year and about 112,500 in another. Again, rough math here, consult your CPA and your own accountant for your own particular situation. And there's things you can do from an entity perspective to help you save on that as well. So make sure you're exploring that. And then finally, we're getting to profit because, this is what we're here in a business for. And I know a lot of people focus so much on revenue and like the things. And I honestly don't care what size business you are from a revenue perspective, because all I care about is like, how much did we keep of it? And this is what profit is. How much is left over after it's all paid, said and done. And that's 10,000 in the first scenario, which is about 10% profit, and 116,000 in the second scenario, because we were able to improve profit by 15.5%, 5.5% better than the first scenario. And that's just because we have more room to play, because we have more money available to allocate to all the things. And as long as you're managing your costs, you should have room for some profit.
Most e-commerce owners I talk to describe their revenue the same way. Great months, followed by terrifying ones with no real idea of what's coming next. So they sit on their cash instead of reinvesting it, and the business stalls out. The root cause is almost always coming down to only having one or two ways to acquire customers, none of them being extremely reliable. At Intergrowth, we help build diversified customer acquisition systems through SEO, meta ads, and content marketing, so that your revenue becomes something that you can actually plan around. Book a complimentary strategy session at intergrowth.com/CGS. Once again, that's intergrowth.com/CGS. So Carla, within this, I'm only paying myself $20,000 a year, but I see $10,000 in profit in scenario one. Why not pay myself $30,000 a year instead?
Yeah, you could. It would be a zero profit break even business. And then when you go to the bank and try to get a loan, you're not going to get it. So instead, what you want to do is you pay yourself $20,000 and then maybe you take some distributions from your business once the year ends, once you know the cash is in the bank. And guess what? Also, you need cash reserves. We're not getting into cash flow today, but that $10,000 is like your starting capital to make your next order of jeans, happen and cover your raw materials, your labor, whatever you need in order to be able to make the sales for the other $100,000 you're going to be, producing. So like, it's not all like, oh, let me just take it home. The business needs money to keep growing and producing results. You can't starve your business of profit because that's what we use it for.
I love it. Putting you on the spot with what I think is probably a really challenging and very subjective answer. But I'm curious how you think about building up cash reserves for the business. Is there, let's say for this business doing $100,000 annual revenue, they're hoping to grow to 750,000 in the next 3 years. The pretty aggressive growth goals. What's an ideal scenario for how much of that money they're keeping reinvested in the business so they build up that cash flow reserves over time?
Yeah, so they're going to have to take some of the profit every month and set it aside. They're also going to need to build what we call, besides cash reserves, I'm talking about this is covering like wages. And if something happens and sales dip and you need to cover a bad month, like this is just table stakes to staying in business, right? What you need here, honestly, in $100,000 business showing some profit is you need a line of credit because you need a working capital to pull from to be able to place your next order without having to lay out the cash for it because you probably don't have it. But you know how to make another $100,000 in sales and another 10,000 of profit. So if you can show that and you can qualify for even a small line of credit, that hovers you for 30, 45 days. Sometimes it's a business credit card. Use responsibly and paid off at the end of the month, please, as a good business owner, right? Not carrying that huge interest because that eats into your margins because that is cost for the business. And using that as flexibility, right? To get what you need, to get the sales that you need to make, to get the inventory that you need in place. And there's obviously a lot of nuances with managing inventory, placing orders, like the cadence of it, the cost of it, storage, and all those things can add up quickly if you can't move inventory quick enough into sales, turn it back into cash. But that is how we start to think about building reserves will come out of profit because there's no other place it's going to come out of, right? Sometimes your vendors that you're working with will give you payment terms. So if you can leverage a 30-day payment term where you place an order, but you don't pay for 30 days, this is another great way to start building a little buffer in your business as you're scaling to be able to use that money for all the things you need to do. But I think where people get in trouble, Pat, honestly, is like they're not using debt or credit or those payment terms responsibly. They're like, oh, I have all this money in the bank. Let me go, pay myself more or go do whatever I need to do in my life, which no judgment here. It's just more like the business needs oxygen and you're starving it of oxygen because you pull out all the cash out of it. Let's not do that. And then over time, you want to build reserves, but it takes time, right? It's not going to happen overnight because we wanted to aim for like 1 week of reserves, then 2 weeks of reserves, and then get to like 3 months of reserves on top of your working capital, which is so critical. And you know what your working capital is? That's your cost of goods sold, number here. So
Oh, brilliant, brilliant. So I know we're coming up on time here, but one other big theme I'd love to pick your brain on is when you look at this jean brand at these two different stages, are there certain red flags that you'll oftentimes see for a hypothetical brand that might fall into either one of those stages that are worth diving into today that, if you see this particular number, that's a huge red flag. That's something that you want to audit. That's something you want to see if you can fix ASAP.
yeah, definitely cost of goods because things can get out of control. You can buy too much and not move to sales and, convert to cash. I always say your cash is sitting on the shelf. So if you can't move your product fast enough, you just locked in all your money into that shelf over there where your product is sitting. So you need to know your sales cycle and you need to know how quickly can you move inventory off the shelf. And you need to work with a marketing agency or someone like Pat to help you create a strategy on how you're going to get more customers to buy your product and make sure that that's working and working well. Because otherwise, you're just sitting on inventory, your money's tied up, your cost of goods margin is probably not as good because you're just spending more money on things that you're not selling. So you have to control costs. And I think that's a huge red flag when I see just COGS in general out of control. I'm asking a lot of questions like, did you order too much? Or did the supplier increase the price on you and you didn't even know? what are we doing? Are we paying upfront? Like what's happening? So we can kind of get it back under control. And then same with operating expenses. I often see founders want to get the office and the storage space to grow into because you're going to be a $5 million business tomorrow, and then they overcommit on something they don't currently need. And so I wanted to operate from like I'm constrained, bursting in the seams in space, and now I'm going to just get like the next step up from that. Like so, if I had 500 square feet, I'm going to go to 600 square feet. And then I'm going to go to 1,000 square feet, but don't go from like 500 square feet to a 5,000 square foot storage unit that you think you're going to grow into and lock up so much of your money ahead of time. And that's just one example. I see it with payroll. I see it with, just not even investing in marketing sometimes, like the opposite, right? I'm like, red flag. I'm like, where's your marketing? Who's doing marketing? Like, is it just you? Like, is it working? Like, what are your metrics? This is where, having key performance indicators really come in to help you understand like what moves the needle. Are things going better or worse than the month before, than the year before? And really comparing like, your journey, like, are things improving or are things getting worse? And if they're getting worse, what are we doing about fixing it? Because I think founders often look at their numbers, they just stare at them and then they walk away like, okay, good to know. And then they don't do anything different. It's like, no, go change something. Like something's got to change in order for this to improve. Go have that negotiation, go have that conversation, go get a better price. Like, got to make that happen. Otherwise, like I said, it doesn't just happen magically, right?
So, Carla, this has been amazing. And listeners, what we'll do is in the show notes, we'll add a link to this working Excel doc. We'll make it view only. So make a copy of the document. You can modify it. Again, this is a very, very rudimentary document that we're working with here. There's a lot more layers that comes into building out a great financial dashboard, but it's a great V1 that you can start looking at to start looking at how your own numbers stack up. But Carla, you've given so much value. How can listeners get in touch with you if they want to work with you and really get your help on a fractional CFO type basis?
Yeah, they can check us out on our website at wealthworthwithin.com. They can book a call and just have a conversation with us on like, can we help you? What are you working with? What support do you need? And we are happy to just meet your needs. My team and I are highly experienced financial professionals helping, e-com brands get more profitable, improving their margins, and looking at this unit economics that I think is so critical for your success. And we would love for you to check that out. And if you like podcasts, we have one too. So if you want to get better at your business finances, go check out our CEO Financial Clarity Corner podcast. We put out a ton of educational content for free. Hopefully you can take action from that and start working on your numbers.
I love it. Listeners, look for the podcast link in the show notes as well, and definitely check that out. And once again, listeners, this is Carla Titus, the founder and fractional CFO over at Wealth and Worth Within. Carla, thank you for coming on today.
Thanks for having me, Pat. I appreciate it.
Thanks for tuning in to Customer Growth Sessions. If you found it helpful, subscribe and give us a review. It helps us to grow the show. Looking for more SEO guidance on how to grow your business? Contact us at intergrowth.com/estimator or email me directly. You can reach me at pat@intergrowth.com. That's all for today. We'll see you again soon.